all to the topic on the fundamentals of Indian financial system. Today's session is framed to introduce to you what a financial system is and how it is significant for the economic development of a country. Before we begin the class, it is better to understand the meaning of a financial system. So we can start with a system. What is a system? A system is an arrangement where organized set of elements work together to create something whole. You must be familiar with different types of systems like the nervous system or the digestive system of your body, a decimal system, solar system, an ecological system, a computer system, an operational system, and so on. So in all these systems, you can see many components or factors or parts which are interlinked act together to make something complete. Likewise, a financial system is also a kind of system where you can find the presence of many financial components acting and working together to make financial activities possible. Now let's see in detail what a financial system is. A financial system is a combination of diverse financial participants channelizing funds from one source to another. Then we have a question why there should be a channelization of funds or why funds have to flow from one source to another. Consider in an economy with two major participants. We can call them the savers and investors. The savers have a surplus of money left after their consumption and they are in search of different avenues to deposit these surplus. In the case of investors, they are always involved in many productive economic activities and they are always in need of funds, but they always lack funds. So they are in search of funds to allocate them for diverse productive activities. So we have the savers having surplus funds and the investors with deficit funds. So in this situation comes the relevance of a financial system. A financial system with its diverse intermediaries act as a link between savers and investors. The financial intermediaries in a financial system pool the savings of the people and channelize them to different productive activities. So, a financial system makes the flow of funds from savers to investors possible. Thus, a financial system, through its various financial components, create a link between savers and investors or the depositors and borrowers. So, who all are there in a financial system? A financial system is basically an institutional framework consisting of various financial institutions like commercial banks, insurance companies, mutual funds, specialized financial institutions, and so on. Also, we can find financial markets in a financial system. These financial markets provide short term as well as long term funds for the investors and such markets we call the money market and capital market. Along with financial institutions and financial markets, we can find the presence of many financial instruments like shares, bonds, debentures, and so on. So we have in a financial system financial institutions, financial markets, and financial instruments. So, what is the need of such a system in an economy? You all know that capital formation is an important process required for the smooth economic development of a country. The pooled savings of the people are diverted by these financial intermediaries to investors who in turn use them for different productive and economic activities. So this makes capital formation possible which can supplement economic growth of the country. So the efficient pooling of savings and their allocation to diverse economic activities through the investors is possible only through an efficient financial system. So we can say the role of a financial system is very vital for the economic development of the country. Now let's see the working of a financial system. As I said, a financial system helps to transfer funds from one source to another, that is, from savers to investors. In a financial system, there are a number of financial intermediaries who facilitate this transfer. These intermediaries pool the savings of the people by issuing a return claim. They then divert the funds to investors who use them for various productive purposes with the hope of getting higher returns. From the returns they get, the investors pay a part to the financial intermediary from where they borrow funds. And these financial intermediaries in turn pay a part to the savers against the claim offered. Okay, I will make it simple. Consider a commercial bank as a financial intermediary. You have an excess money after your consumption which you need to save. The high interest rates offered by banks on the savings account attract you to deposit that surplus in a bank. So, bank claim a return on your funds with an interest rate. After keeping a portion as reserves, bank lends this money to investors who are in need of funds. By charging an interest rate on loans, bank lend money to them. And these investors invest these funds on various productive activities and earn returns. Gradually, by the end of the loan period, they pay off the debt, that is, the loan taken from the bank, along with the interest rate charged. So, the difference in the interest rates charged for the savers' deposits and the charges imposed on the loans of investors mark the profit of the intermediaries. You have to keep in mind that this is just an example with commercial bank as a financial intermediary. The activities and functions and return claims are different to different financial intermediaries and for different institutions, different financial markets and for different financial instruments. Now let's see the features of a financial system in India. In Indian financial system, you can find the presence of both organized and unorganized financial participants. Organized participants include commercial bank, then life insurance companies, mutual funds companies, and so on. They are completely regulated and controlled by a monitoring authority. Whereas there are certain participants like money lenders, then indigenous banks, etc., who are not under the control of any regulatory framework. For example, we know that we have the Reserve Bank of India to regulate and monitor the working of commercial banks in India. And also to control and regulate the capital market, we have the Securities Exchange Board of India or SEBI. Indian financial system also enables a flow of funds among various entities ranging from households to firms and among governments. It stimulates the allocation of financial resources for various productive and efficient activities. And we all know that an efficient financial system helps for the further expansion of the financial system and their intermediaries. Also, Indian financial system supports capital formation in a country. It also ensures liquidity in the market and thereby it promotes development of the country. Now let's summarize what we have seen today. A financial system acts as an intermediary between savers and investors. It helps to pool the resources, that is the savings, and make possible the allocation of financial resources to investors. The investors use these financial resources to different productive and innovative activities. So, a financial system always helps in the capital formation and it supplements the economic development of a country. This is just a brief introduction to the topic on financial system of India. The details of the Indian financial system, its structure, its components can be discussed in the coming classes. So thank you for watching and we will see you in the next class. Goodbye.